Brad Williams, Frugal Finance, a short hedge and hedge ratio calculation. As a first case, consider the manager of a well-diversified stock portfolio with a value of $40 million and assume that the portfolio has a beta of 1.22 measured relative to the S&P 500. This implies that a movement of 1% in the S&P 500 index would be expected to induce a change of 1.22% in the value of the stock portfolio. The investment manager worries that a bear market is on the horizon and wants to hedge his portfolio value against that possible downside. One strategy would be to liquidate the portfolio and place the proceeds in a short-term debt instrument, and then, after the bear market, return the funds to the stock market. Such a plan is infeasible. First, the transaction costs for such a transaction are quite high. Well, not so much today, but just think about it. Selling a $40 million portfolio just because you think there's a bear market in the works? How about if the fund is large, liquidating the portfolio could drive down stock prices? 40 million wouldn't be anything, but if it was 400 million, it might. This would prevent the portfolio manager from liquidating the portfolio at the prices currently quoted for the individual stocks. So what do you do? As an obvious alternative to liquidating the portfolio, the manager could use the S&P 500 stock index future contract. Selling futures, investment managers can possibly offset the risk of the bear market on the portfolio by generating gains in the futures market. It's the same thing as we did with that baker, the farmer. In this case, think of the portfolio manager as the farmer. All he wants to do is hedge his wheat, or in this case, his portfolio. Selling futures, the investment manager can possibly offset the risk of the bear market on the portfolio by generating gains in the futures market. One kind of naive strategy might involve selling $1 of the value underlying the index future contract for each dollar on the portfolio's value. Naive strategy. Just keep that in mind. There's a clue. Assuming that the S&P index futures contracts stand at 1060, the advocated futures position would be given by VP divided by VF, negative 40 million. Divide this by 1060 times 250 equals 250.94 equals negative 150 contracts, where VP is the value of the portfolio and VF is the value of the futures contract. Stock market, May 19th, hold 40 million in a stock portfolio. Sell 150 S&P 500 December future contracts at 1060. August 15th, stock portfolio falls by 5.4% to 37.83816 million. S&P futures contract falls by 4.43%. Oops. So you lose 47 million here. You gain 47 basis points times 250 times 150 contracts equals 1.762. They have a net loss of 300 and almost 400 grand. Not such a great hedge strategy, is it? Well, you remember that beta situation? One problem with this approach is that it ignores the higher volatility of the stock portfolio relative to that of the S&P 500 index. As noted previously, the beta of the stock portfolio as measured against the index was 1.22. Table 710 shows the potential results of a hedge consistent with these facts. I don't have that table, so ignore that. The portfolio manager initiates the hedge on March 14th. So table 10 shows the potential results of the hedge. The portfolio manager initiates the hedge on March 14th, selling 150 December future contracts against a 40 million stock portfolio. By August 16th, his fears have been realized and the market fell. The S&P index and the futures, they both had fallen by 4.43% to 1013. The stock portfolio, with its greater volatility, has fallen 1.22 times as much, 1.22 times 4.43%, generating a loss of 2.161 million. This leaves a net loss on the hedge of 3934, or is it 399? I'm going to go with 399 and change this just to stay consistent. And I'm sure if I just subtracted this to this, it'll give me the right number, and really I don't care. You kind of get the idea. A failure to consider the different volatility between the stock portfolio and index futures leads to suboptimal hedge results. Keep that in mind. Volatility, key variable that you need to be able to compute when you're doing this. The manager might be able to avoid this result by weighing the hedge ratio by the beta of the stock portfolio. According to this scenario, the manager could use the following equation to find the number of contracts to trade. So now we have B of P divided by B of F, and where beta P is the beta of the portfolio that is being hedged. Using this approach, for example, manager would sell 185 contracts versus the 150. 122 times 40 million divided by 1060 times 250 equals negative 1815. And for clarification, the number was wrong. It was 250.94. It was supposed to be 150.94. Sorry about that. Just want to clear that up. So anyway, back here, we get this number. We have 184.15, or we round up 185 contracts. Had the manager traded 185 contracts, the futures gain reported in 710 would have been 2.17375 instead of 1.725. This higher gain would have almost exactly offset the loss on the spot position of 216184. Note, however, that these excellent results depend on two crucial assumptions. First, you coming up with this example, you probably want to sort of work the numbers favorably into the discussion. But first, such results could be achieved only if the movement of the stock portfolio during the hedge period exactly corresponded to the volatility implied by its beta. Second, the technique of equation 7.6 uses the beta of the stock portfolio as measured against the S&P index itself. This assumes that the futures contracts move exactly in tandem with the spot index. This assumption is clearly violated by recent market experience because the future contracts for all of the indexes are more volatile than the indexes themselves. This is reflected by the fact that the futures contracts generally have betas of 1.0 when they are measured relative to the stock index itself. The methodology of equation 7.6 does not take this into account, since it implicitly assumes the index and future contracts have the same price movements, which would imply equal betas. We will consider more sophisticated approaches moving on. Brad Williams, Frugal Finance. Thanks for watching.